All right, great. Everybody can see me. Fantastic. Thank you, everybody. Let's get this show on the road.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockwell.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right, we are good to go. Let's see how the market's doing for starters. I think we're flat, pretty much flat. Not very exciting, but that's okay. So we came out right to that 31.35 line right there. That's 10% line on the S&P. And keep trying to get over that. The Nasdaq's over 10,000 though, so there you go. There's a good breakout sign. And here's 1450 on the Russell is a bit of resistance, and 26.5 on Dow has been the resistance line right now. So that's what we're looking at as far as like ranges for that. But on the whole, I just think, I mean, it's hard to imagine we're going to go much higher than this based on the fundamentals. But on the other hand, the government was talking about putting another $1 trillion in and whatever. It's all crazy to me. Sure, our portfolios are astounding. Oh no, wait, Hemboka portfolio dropped today. That's interesting because we just showed that this morning. Actually, that's not even real, you know, I mean, as you know, we got rid of that one, but it's interesting to see how it performs over time as it's closed. Butterfly, 102%. That's so crazy for the Butterfly portfolio. Hey, don't forget, we're starting our new hedge fund, which follows, it's not going to follow the Butterfly portfolio, but these are the kind of trades we're going to put in our new hedge fund. And it's been a while. It's been 2 years, two and a half years, but 100% in 2.5 years is pretty much what this thing's supposed to do. I mean, it's really on track. It's doing very well. You know, we look to make like 30% a year. We're very, very happy. That's what we're aiming for in this kind of portfolio. You don't want, you know, the idea is steadiness more so than huge profits, and also pays out a nice little income. So all these dividends. Speaking of which, the dividend portfolio down 9%. Down 9% is great though. This thing was down 50% at one point. So dividend stocks are back in favor at this exact moment, but who knows how long that'll last. So I'm not sure what I want to do with this. I'm gonna have to consider that when we do the review. Earnings portfolio. Now, oh, wow. So the earnings portfolio is up 98% now. Holy crap. What on earth did we do so right? Oh, this guy did really well. Oh, that's our hedge. Oh, that's funny. So we have the SQQ hedge. That's interesting. The SQQ hedge did really well. iRobot did really well. Look at iRobot up here. That's adding a lot of cash. So we just had some good plays. And also don't forget, we took a lot off the table on the earnings portfolio because they were short. A lot of the early plays were short-term earnings plays. Then the market crashed. And then what we did is we took all the ones that we still liked that were not, you know, that we wanted to stay into, and we put more money into them and turned them into these bigger positions because we were like, it's like even ACB, we're like, oh, ACB went down, we'll buy more of that. HBI went down, we'll buy more of that. You know, H&R Block went down, we'll buy more of that. So we just bought more and turned them into longer term positions. So it turned into more of a long term portfolio, but you know, what do you expect? 98%. So futures now, that's just our stocks that we think are very good for the long haul. And these don't all have the newer positions are not in here yet. I got to do a lot of homework to get those in. So this is up 40%. This only started in December, and it hasn't got very many positions in it. Still sitting on 100,000 in cash, but it's doing well. And what do we got in here? We got Total. Well, let's see who's doing this. Total's doing good. SunPower is still flat, still a great stock to get into. SunPower again doing better. That one's doing better. Beyond phenomenal. I mean, you know, wow. We have the 40-65 spread. This has got to be done, right? There can't possibly be more left in that thing. We have the 40-65 spread. And these guys, oh, I just screwed up and put away the chart. It's too small. There we go. New tab. La la la. There we go. And we say, who the hell are we looking at? I was Beyond, BYND. Wow, look at that thing go. And you know, we've done very well on Beyond. We actually shorted it back when, you know, the IPO, we shorted it, and then it went down and we went long because I said, you know, and then it came back down and we said we went long again because it was like, you know, we're just playing the channel of what it's worth. It's not worth this much. So we need to address that in this position. Oh, I'm sorry, we're going up. There's Arconic, that's like Alcoa, and they're doing good, but I'm not really confident in the aluminum market, so I'm not sure we're going to keep that. You know, that's one thing. When you're at a toppy bit of the market, you really want to pare down, and any position you have even the teeny tiniest bit of queasiness over, just get out of it. Why should you have anything you're not 100% sure? But we looked at it before. Money Talk we just did. And Money Talk was up. I mean, I just did that interview like 2 days ago. It was like not even, it was just about 9%. Now it's up 12%. So it's kind of crazy moves we're getting off these things in a couple of days. And then we got the long-term portfolio. This is where it's really crazy. 71%. We started in October. 71% gain, which puts us at $850 blah 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 $1,000. And then we combine that with the short-term portfolio. I'm not going to go through all those; it's too many positions. But well, you know, we'll review them when we review it on Friday probably. And then you got the short-term portfolio. That's 512. So if it was 850 plus 512, and it's a little bit more of both, you're talking about you're getting close to $1.4 million, which is crazy from $600,000 start. Both portfolios very, very profitable. As you know, we're going to have to bump up our hedges in the short-term portfolio. We have that CMG short that's doing very, very well, even though CMG is pretty, you know, CMG is still pretty high, but on the whole, see, that's the thing. When you sell this much premium, you don't have to be right to make money. You sold the premium. That's a given. See, it's still way at the top of the range here, CMG. So we're at 1038. And this position is what? We have the, oh, it's an income play. I forgot it was an income play. Okay, so we own the 2022 950 puts. And we sold the January this year. So we got a year spread. We have the 950, 750 put spread. And we shorted the 1050 calls. And we also sold the 850 puts. So our short-term play is we sold these puts and they're done. They're 18 cents. So we need to sell something else. We don't need to, but I mean, look at the profit on this thing. It's $7,000. So short-term, we sold these guys, the 850 puts, which we thought was way too low. We sold the 1050 calls, which we felt were too high, but they're up at 1040. So maybe we were wrong. But even though we were wrong so far, we sold them for $50 to some idiot who thought that they would be at $1,100 by July. And they might still be. But even if they are, we don't owe any money. They have to be over $1,100 for us to lose. Right now, they're at 38 because why? It's getting closer to July and they're not over yet. Therefore, they start losing their premium at a very rapid pace at about $1 a day right now. They're going to start decaying. And every day they decay $1, we make $200. And it don't sound like much, but it adds up to $7,600 in a month. It's little things like that. See, that's the thing. You make a play like this and you say, oh, so what? It's only to make like $1 a day premium. So, it's a big deal. The big deal is it's 200 times $1 a day is 7,600 in as many days as we have left. That's a big deal. Nobody looks at $7,600 and doesn't think that's worth a play. We do that all the time because we do understand the time value of premium and how we can use it to our advantage. That's what this is all about. We know for a fact whether CMG goes up or down, and we did this put on 519. I guarantee you CMG was lower then. May 19th. Look, they were here. They were at $900. So they're like $150 higher, but there was so much premium in that because you're anticipating 11. So look at your track. If you want to know how your option is going to perform, look at your track. We're May 19th, so probably around here, around $900. We sold the 1050 calls for $50. So if you extrapolate another month out, because they're going to expire in the middle of July, if you think of the track this has to get to over 1100, it has to be at 1100 or higher for us to lose money because we sold them $50. That would be here. So are you on track or off track? And you see how it's gyrating. So it's funny how that triangle is going to come out. Well, it's not funny. That's really what the options predict, right? Doesn't the options market predict the most likely position the stock is going to be in on that date? It's the break-even point. It's like the over-under in football. It's the line that the intelligence of the market has bet, and the intelligence of the market of these trends. The intelligence of the market has bet that CMG will be here on July expiration. And we bet, sure, why not? That's the trick to what we're doing, right? We're not betting against it. We're not betting for it. We're basically saying, yeah, that's a good line. I'll take a guy's $50 to bet that that's going to be higher. I don't think it'll be higher. And you know what? I'll take a guy's $50 who bets it's going to be lower as well. Because they're both probably wrong. It's probably going to be right at the line. Everyone loses. That's how Vegas makes all their money, right? And by the way, people don't get that. You think of a bet and you think of the odds and you say, well, how do they really make money, the bookie? Because they're going to pay one side or the other. So what do they get really? First of all, they're not paying you the full percentage, right? Like on a roulette wheel, they pay you 35-1. But in addition to the 36 numbers on the roulette wheel, there's also a 0 and sometimes a double 0. So any wheel with a double 0 is going to take 3% more of your money. That adding that one more number makes it 3% less likely you're going to hit your number when it spins. So right away, the house has a tremendous advantage. So on roulette, what do they have? They have three numbers. Three numbers that don't pay you. Number 36, although you can bet on it, you're only getting 35-1 odds. They have number 36, they have 0, and they have double 0. So therefore, 3 times 3% for each one, 10%. The odds are 10% against you when you bet on a number because they don't pay you enough and they don't give you the fair odds in the first place. So that's how you lose money. There's that way of losing money. There's also now see, that's the thing. Sometimes people win, sometimes people lose. But when you do a game like when you have roulette, when you have like double 0, for example, when you hit double 0, the people who bet on red lose, the people who bet on black lose. Most people don't bet on double 0. So and if you bet on double 0, all the numbers lose, right? So therefore, the best thing for the house to hit is 0 and double 0. So that's why a lot of houses have 2 double 0s because all the red and that by the way makes the red and black bet terrible. If you're at a double 0 table, roulette spinner, and then you've got, instead of you're getting paid even money, except that it's not even because there's 2 numbers there that aren't red or black. So there's a 2 out of 30. There's a 15-16% chance or 18, whatever the hell it works out to. It is not 15 or 16. What am I saying? the 5 or 6% chance that you're not going to get paid on red or black in every spin. You can hit 0, double 0. Same thing with what we're doing, right? This is our 0, double 0 play. We bet the trend. We bet exactly at the 11.50. We bet at the 10.50 line that it wouldn't get to 10, 11. Why? It's trending to 11, but I don't believe value-wise it can hold 11 into this time period. So maybe I'm wrong. You know, you never know. But I think earnings are after that, so we even get to make another bet in between. But meanwhile, we were more conservative with the puts because I felt it was going to go down. So we only sold the 850 puts and we sold them for this month, way down here. So now we're in May. I sold the 850 puts here that expire. Wait, what month are we in? June? Oh, okay. Anyway, so this is the middle of June. So we sold the 850 puts that expired already. There wasn't very much chance to me that it was going to go below 850, and even if it did, what do we sell the puts for? Dun, 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 dun. We sold the June 850 puts for $37. But the only way we could lose on the puts is if we won on the calls, right? So we really had 37 plus 49. It's like $85, $86 of room to be wrong in either direction. That's why these are so fantastic. You know, and I'm going to spend time on these kind of plays because it's how you make look at the money you make on these sort of things. It's incredible. Incredible. We started this trade in April, and here, right, just in this particular set, we're up 24, 25, 26, 27, $28,000. There's so little risk in something like that. If you manage, you just got to pay attention and manage it correctly. You know, if it starts spiking up, yeah, you got to do something about it. But as long as it's going flat or on track, it doesn't have to be flat. It just has to be predictable. You're going to make a ton of money. So let's see. Do we have any questions? Nobody has questions. Great. Okay, cool. What else? All right, that's the short-term portfolio plus the long-term portfolio holding up amazingly well. Oops. And do we do all our portfolios? Yes, we do all our portfolios. Yay, we can move on to other topics. All right, fantastic. And I'll do obviously the full portfolio review and so on and so forth. And we'll see what happens. Powell says, this is not the time to worry too much about fiscal situation. That's interesting. Like, don't worry about the money. We got plenty. We're going to give it out. It's going to be fine. Very enjoyable stuff. I really like it when he talks. It's just an amazing view of the monetary world. Oh gosh. All right, tired. All right, anyway. Yeah, I need a nap. Sometimes you just need a nap. All right, where are we? So we were talking about that. I know I had some talk. Oh yeah. I just get sidetracked. All right. I'm going to delete this one and move it. So all right. May 27th, 5.6 million infections, 350 deaths, 1.6 in the US. That's 3 weeks ago, right? Let's call that 3 weeks ago. Then 2 weeks ago, we can all agree that 6.3 was 2 weeks ago, right? Just coming up to 2 million. That's from what? Is that US? Stupid thing. Oh man. Once you look at the US and you leave it there, I should have put it back. So now it's not staying on that. If I go back now, it's going to show me the refreshed. Damn it. Anyway, that's when the US crossed 2 million right then. That's why we were looking at it. I made 112,000. Now, last week, 5.6 million to 7.2 million in a week. 2 weeks. Wait, 2 weeks. And they tell you not to worry about it. 352 dead. 422 dead. Tell you not to worry about it. Like the leading cause of death in the world, practically. Unbelievable. What else? Then we get to here. This was the old one. Now we're going to erase that. Oh, I should have erased the one, damn it. Stupid. I should have erased the one that was already shot. So now we have 400. So last week, 422. Now we have 445. That's not so bad. Only 23,000 more people died. Infection-wise, though, 7.2 million last week, and today the 17th, 8.2. That's 1 million people per week becoming infected around the world, but mostly in the US, in Brazil, in Russia, in India, the UK. All with popular idiot leaders, basically. That's the theme. The guys who don't care, who go with their gut, who ignore the scientists, who just do what they feel like, those are the countries that are like that. The countries, you go down this list, and it's almost like you can see the list of like watch what happens. You go, not known, not known for scientists, right? Most of these countries, they get France, very into medical care, Germany, Chile, couldn't speak to Turkey, Mexico, though, is interesting. Pakistan, Canada, then you start getting to the real low cases. Canada, Bangladesh, China, Qatar. Qatar, a very rich oil country. They're not like Saudi Arabia. They don't have like 10 million mouths to feed. So they got way more money than the Saudis. They are best of everything kind of country. South Africa, Belgium, Belarus. Colombia is interesting. I don't know how they escaped it. Sweden, Netherlands, Ecuador, Egypt, UAE. Also, again, like they'll spend the money for it. Indonesia, Singapore. There's factors involved, of course, but the countries that have the universal health care, the countries that have the leaders who'll sit down and create a science council and listen to what they have to say and stuff. That's where you have the lower cases. And Brazil is like out of control. We're completely out of control. You can't even see America anymore. I remember when it used to be like this when we were talking about like, oh well, the rural states, they're not gonna, they're lucky, they're not gonna be so affected. And look at it, bam. Where there's people, there's virus. That's basically the way this is now. That is crazy chart. You can see China better than America. And there was a point when we couldn't see you can't see it on this level, I guess. Japan was blocked out by the size of the dots that you couldn't even see it anymore. So this is it's moving. I mean, I guess you could. I mean, hopefully it's moving. It's going from here to here to here, and hopefully it'll go away and not just roll right back around the world. Starts here, somebody sneezes, and here's all the little particles go flying around, and most of them land on America. But I mean, blaming China for the virus is just completely ridiculous. I mean, I guess had they released it from a lab or something, that would have been something you might want to blame them for, but that doesn't seem to be the case. It's a virus. Viruses come from somewhere and end up everywhere. That's how they work. Oh, look at us though, 2 million people. 2 million people infected. That's just a horrifying. Anyway, moving on. Don't want to talk about this too much, but the reopening has been basically a terrible, terrible thing that we are doing. You can see the chart kind of ticking up here. It's a little, you can't, it's not a set in stone kind of thing yet, but it's not something I want to mess around with either. And, here's 615, 2114, and 616, 2138. So 114, 138. They look at 24,000 people infected in a day in America. 24,000 people. China's total case count over all those months was 84,000. And we got 24,000 a day. We are so much worse than China, so much worse than Japan, so much worse than Europe. There's no level that you can look at and not say that this country is just basically completely out of control with this virus. And we're still basically not doing what we're supposed to do to fight it. So this goes back to now, this is my premise for saying we need to take a lot more stuff off the table. You cannot trust this thing. You can't say this is going to just keep going. You can't, I don't see how we can blindly accept this. If you accept this and think that we're going to just keep going up from here, then you're saying there's no consequences. And look, to some extent, the Fed dumping money on everything, maybe there are no consequences, but maybe there is. So, you know, at some point you have to think, and it might be Q2 earnings, which are going to be completely and utterly a disaster of biblical proportions, because we were in lockdown in April, we were in lockdown in May, most of it, and June, if you've gone around, I don't know how these restaurants are going to survive. I don't see how their business model was for them to have one half as many people in it as a maximum, and then other days they're just as empty as they usually are. I'm going out tonight. I'm going out to dinner. You know, I'm going out to dinner to a restaurant that's 100 feet from my house, and they have outdoor patio and all that. Oh, hey, make the reservation. Wait, not tonight, tomorrow. Oh, that's okay. All right, I'm not gonna worry about it. It's the first time I've been out to dinner since Jackie left, which was back at Memorial Day. So I don't know. It's just weird because I gotta think about, you know, you have to balance out the virus and the problems it's causing compared to, I mean, these guys in Trump's administration, they don't seem like they're gonna they're not gonna lock us back down under any circumstances. Another lockdown in July, right, is gonna obviously destroy travel, tourism, blah, blah, blah. I mean, you know, the amount of places are gonna go bust. I was just talking to a guy, he's buying a bunch of luxury hotels because they're so cheap right now. So, I mean, God bless him. I'm like, dude, that's interesting. But he's talking about buying 5-star hotels for $100 to $200 million. That's how much they're hurting. That's crazy. There's a lot of stuff on the block that you just would never get otherwise, and he's taking advantage of it. You know, but I was, you know, I didn't want to like burst his balloon, but I was like, I don't know how fast that's all going to come back. Could be a while, but he's got a longer term picture. He's like, well, eventually people will figure it out and we'll be there for the hotels. So where was I? Oh yeah. So you've got that pressure down, and we're obviously in a recession, though nobody seems to want to admit that we're in a recession. A recession is 2 quarters of negative growth. We're clearly in a recession. Last quarter was down. This quarter's down 50% at the moment. Maybe it'll improve by the end of the month, but it's going to have to improve a hell of a lot, and I don't see it. I don't see it at I went to the AT&T store the other day. That was brave. I got a new iPhone with my old, you know how your old iPhone after 2 years just starts doing things to you, basically telling you it's time to get a new phone. It starts annoying you in various ways. So mine was doing that. So even though I was perfectly happy with it and was going to hold out for 5G, I was forced to go to the store and get a new phone. Oh dear. Not a long webinar today because I'm pretty tired actually. I didn't get enough sleep last night. Anyway, so where are we? iPhones, right? So, and having nothing to do with it. I went to the AT&T store. Guy's sitting there by himself. Nobody there. The whole plaza where he was in, nobody's there. I went to Whole Foods. Nobody's there. I mean, people are there, but it's not crowded. Nothing's crowded. Nowhere's crowded, and this is Florida. I mean, even though everybody's so relaxed about everything, nobody cares about masks and whatever. It's still not crowded. There's a lot of people not going anywhere. You got to run in the streets when you go out. So it's I can't see economically how this is going to be so great. I don't see they're going to have a big bounce. All we have is an artificial. Look at this short time frame too. They put $6 trillion to work. And all they got us was this. It's the same money. Whether we get here in a V, see what the V is. They were going for the V. That's what they wanted. They wanted that V. They ain't getting a V. They're going to get a W. We're probably going to pull back more. And then we can start to recover over maybe a longer period of time. But that's what we're going to get. We're going to get more like this kind of thing. Like here and recover. And then, okay, maybe one day we're going to go higher. That's where we are. Everyone's fantasizing this is going to happen, but look how long it took here. Here's your peak, here's your fall, here's a basically slightly higher peak if you call that, but falling back to this line, back to this line, back to this line. Very simple. That's more likely than we're going to rocket up and go past where we were and down 20, 30,000, whatever the hell numbers they're throwing out now. It's silly. And it's probably not going to happen. It's probably going to be, settling in around this range. Where we are now is about where we should be. That's what I've been saying, the 10% line on the S&P, which is 31.35. See, look at that, exactly. 31.35 is exactly the 10% line on the S&P. So everything, when it's higher, it shouldn't be that high. When it's lower, it shouldn't be that low. Not complicated. And what do we do when we do that? We sell puts, we sell calls, we don't care. We sell to dummies who think that they do know what's going to happen. We don't pretend to know what's going to happen. We just bet that the most likely thing to happen is the most likely thing to happen. That's our bet. All right, so who's got questions? JC says, what would you suggest as a new CNG play since the stock is high now, the market is toppy? I assume it's an even better entry point. Well, sure, yeah. Well, I mean, look, it's not a better entry point on our plate because we already made all our money. Honestly, to put it together right this second would be very hard for me because hurt my brain. I would suggest having a lot of margin. Like look at this, we have $300,000 in cash in a $500,000 portfolio. So we got, wow, I only started just now before the webinar. So we have much more cash than we usually have. And it's just doing nothing. So we're sitting around with empty buying power. We're using it on plays like this. It's not a big deal. It's only, it's a spread, 950, 750 bear put spread. We're way over that, but that becomes a buffer for selling these puts, the 850 puts. And then this month, we're probably going to sell the 950 puts, and we're going to keep this spread, which is net. Well, it's net a lot. Wow. Look at the price of that. Now, I wouldn't know that maybe you find a different combination, but the concept's the same. Is you find the spread covers the puts and the calls. I mean the short puts anyway, not the short calls. And but of course the nice thing about what I like about the short call though is that if this goes in the money, not that it looks like it would now, but if this went in the money, this would go out of the money and you're gonna get paid anyway. You're gonna get $50 towards whatever you lose on the other side. That's what makes it a good play. Ask me in chat for like more specifics. So, because it's too much for my brain right now. Honestly, I got to tell you, I'm like really got tired. What else do we talk about today? I thought I slept enough last night, but I don't think I did. So, is this today? It seems like last week. Wait, it has to be last week. All right, well, we talked about that, that's where we are. That portfolio, nope, nothing exciting otherwise, so nothing much to talk about there. So we got Powell talking, I don't know what he's saying now, he's still talking, he's like, I guess he talks more when he's at home, right? Like he's just hanging out, chatting. Got nowhere to be, got nothing else to do. That's very interesting. Oh, like, we're doing this PPE equipment, which is why, well, honestly, that's why I'm so tired. I'm just doing that also in addition to what we do usually. And we're trying to work with 3M selling masks, and we're also selling those gloves that people, for everybody, doctors and anybody who's like emergency workers and all the people who work in stores and stuff, they have these gloves now. So we're selling those too. And it's New Age Investments is anyway, so that's one of our PSW projects. And you run into a lot of stuff, but what I found out is I'm like, why does everybody offer to buy gloves for $12.50 or less? So in other words, there's a mad scramble of buyers, let's call them, but they're not really buyers, mostly like either middlemen or investors. And they always want to buy gloves for less than $12.50. They won't touch them if they're over. And you think to yourself, if I've got a month's supply for $12.60, and they're going to shop around and shop around and shop around looking for $12.40. What is it? Why are they doing this? Well, the reason they're doing it is because FEMA, Mike Pence's project, is offering to buy any amount of these gloves for $12.50. So they run around offering $12.50, and they've got, hundreds of billions of dollars. So they pretty much buy anything somebody has for $12.50. If you have to know a contractor, but if you can get your stuff into a contractor, they'll take it away for $12.50. And people do, obviously. So again, we talked about that last week. Rich get richer. If you are able to become a middleman in these transactions, if you have access, that's all you sell. When they talk about access, you sell access. Okay, Mike Pence says, tell this guy I sent you, he'll help you out. He'll talk to you. All right. And what is a talk conversation? Hey, I was looking into bringing masks into the United States, or bringing gloves, nitrile gloves into the United States. So what's this deal you guys have with FEMA? What do we do? And he's like, oh, let me put you on the phone with this guy, the head of FEMA in your area, and he'll tell you what he's willing to pay. And that guy from FEMA goes, you know what? We're willing to pay $12.50 a box. That seems to be the going market rate in the U.S. And sure it is. It's $12.50 a box. But you know what's funny? If you go to Vietnam, if you go to Thailand, if you go to South Korea, and you go get them yourself, that $12.50 box of gloves is more like $7.50. And it don't cost no $5 to ship a box of gloves from Thailand to the U.S. Because if it did, we wouldn't have toilet paper, and we wouldn't have tissue paper, which is tissue paper is basically the same size as the box. The gloves come in a box, and there's about 100 gloves in a box. That's how it usually works. It's kind of like tissue paper. They just pull them and they put them on their hands. So crazily, the price is effectively set by the government. All the speculators will pay up to a penny or two below what the government pays just to get a little bit of margin in it. They're going to flip it right away. That sets the entire market price, but it sets the entire market price at a really high price. And that's what makes room for all these middlemen, and capitalism does dictate that they all run in and fill in this flood. So it's crazy. It's a crazy market. It's completely mismanaged, and but on the other hand, it's a ton of money to be made. You got to get, if you can make the right connections and bring this stuff into the country at a good price, it can be flipped for a tremendous price. It's amazing. You can take it off a boat $11.50 and sell it to a speculator who's going to sell it to the government, but they'll pay you $11.75 because they're going to make 50 cents. Or you can sell it to them for for $12, and they'll sell it to the government for $12.50, and you're both going to make 50 cents. 50 cents times 100 million boxes. And that's all you're doing is going to Vietnam, get your gloves, put them on a boat, bring them over here. It sounds like nothing, but it's stuff. But honestly, it's not that hard. And then when it hits the ground in America, it becomes much more valuable because it's on the ground. Nobody has to wait for shipping. Nobody has to worry about getting ripped off at the factory or ripped off at the boat at the port or ripped off in customs. That's why it's valuable. It's on the ground, means it's in front of customs, and it's clean to take anywhere in America. That's what gives these things their value. You know, when they're restricted or hanging in customs or sitting in a factory, there's 20 things that can go wrong before you get your hands on it. That's the key to it. That's why people pay a premium for stuff on the ground. But to a certain extent, it's not worth it. If you're a 100 million customer and you could be saving $3 by not buying the crap that's on the ground here, just find yourself a reliable supplier, reliable shipper, and get your stuff. It's crazy. Because the government didn't take over the glove business like they took over 3M, so it's very different. Anywho, let's see how the futures are doing. Dun, 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 dun. So indexes, NASDAQ above, far above where, oh no, that's short-term, hang on, still above though. Holy crap, it's even worse. So, wait, is it even gonna go back that far? Sure, well, look at that. Okay, so it was chugging along, 7,500, 9,500, why not? You know, it's like 10,000, why not? Go ahead. 30% up from last time, 33%. Then it goes, crashes back worse than before, but now it comes back better than ever. And we had this discussion about why I object to it on Monday's report or something like that. It's just crazy. How about the VIX? The VIX is the volatility index. Still, there's a lot of people making bearish bets. This is what it looks like when nobody's worried. This is not what it looks like when nobody's worried. Just because it's lower than that, that's panic. This is still extremely worried. You know, so we're way high on the VIX. Look at the history. It just doesn't do that. This is crazy. There's something wrong here. That's the way you got to look at that. Energy also, oh, another thing's too high. Oil is too high. That's crazy. Shorting it to 40 is a good idea. Brent's at 42-ish, I guess. RBAR 121. That's interesting how hard it's going to handle that. It's interesting. Not as good as short as oil. I think oil is a better short at 40. It's a good line. Heating oil, natural gas, good bottom. I think it's playable. I got to really look up on the LNG imports and stuff and exports to see what they're doing and how it's working and has it slowed down. I don't know those answers. So that's something to look at. And then we got the bonds are holding up because of Powell and the softs. And the metals. Nothing exciting there at all. I'm such a boring. I gotta tell you, there's not much going on. Honestly, we're just grinding higher, and people are waiting to see when it's going to stop. But nobody's really excited about like betting in this market, unfortunately. Rice crashed for God knows what reason. Coffee is not on this chart. What? No, it's soft. That's why. Coffee's really low. Oh, that's a good place to play coffee. In the hurricane season, I like that. I don't think it'll get much worse. And then you got the dollar, which is weaker, of course. That's another way to boost the market. The euro surprisingly came off the ground. I'm waiting for them to go flat to the dollar. There's a pound. Yeah, the pound is still there, and the pound's in better shape than the euro. Not much, but a little bit. And that's where we stand. So Powell says Fed's program focus is now on execution. Let's see how that oil report's looking. We have the petroleum status report. And 13 million. Okay, imports average, blah, blah, blah. Imports average, blah, blah, blah. Inventories increased 1.2 million barrels for oil. Gasoline decreased, so that's a wash for sure. Distillates up decreased by 1.4. That's interesting. And others or something, or propane distillates 2.7. No, they actually have a category for propanes. That wouldn't be it. All other oils up pretty flat. So it's kind of a fair reading. I mean, that's where we are. Not that terribly much more than last time. It's only 100 million barrels more than last year. So not terrible. But on the other hand, we're certainly not getting rid of them. Our imports are down. Our exports are down. They're down 2.66. And that's about it. Let's see what else we got here. So where's the oil? How's oil behaving based on that? So the question I have is, did that report really affect oil today? And no. 5-minute chart. Now we spiked up on the report apparently, or into the report, and then it held up there and it came down. Yes, that's why I have this sort of the vibe that it's not really working. All right, so oil is going like that. I would certainly, why does it say 38 something and the chart said more like 40? I don't know, it's 38.70. See, I would short the $40 line for sure, but we're not really there, so I don't know if it's that great of a deal. Let's get back off the track over there. So that's what I'd be looking for, another breakup there, might be worth shorting. But otherwise, things are fine. I don't think there's that much going on. I don't think there's that much to worry about. We're just sort of drifting along, and whether we go up or down from here is going to be based on how it plays out with the virus, how people's attitudes are. And 1 month from now, second quarter earnings, it's all going to hit the fan. We're either going to be up or down from that. The jobs report, I guess they quietly corrected it by now, so that's not having the repercussions we thought it would. And I'm not seeing a whole lot of consumer spending. It's just me. But that's what I was saying before. Like, Trump does not in any way, shape, or form want to close everything back down at this stage where so many people are struggling to stay in business and then have this whole thing start up again. It's not going to help at this point. Which I guess is kind of fatalistic. It's like, we're going to get the virus. It's going to be very difficult not to get the virus. So the best thing you can do is try to keep yourself healthy. So when you do get it, hopefully you get a mild case. But that's the trick. I don't see any real cure for that sort of thing. Let's see. So Bernie asked a new CMG play. Ask me in chat, because that's in, we'll talk about it more. The other day you mentioned you might rethink UNG, but I don't think you got around to it. No, I didn't get around to it. I have to read more. I got to read more on it. Low oil means a restricted NG production when global NG demand falling. That's the thing. There's a lot of moving parts. See, that's you understand the moving parts, but then you're saying, well, Phil, give me an answer. You got to think about that. Oh, that was JC anyway. Hang on. So, oh wait, very confusing on my chat screen. Let's see if I can make it bigger. There we go. Bernie's like in the middle of these people. So JC asked that. Bernie asked HBO is the dividend safe. I don't know if the dividend's safe. Come on, man. I don't think any dividend's safe right now. I mean, come on. Why, Haynes, popular as they are, I don't think people are really going to Amazon.com looking for Haynes. It's like once you're there, you're going to be on like other sites and things. I don't think that's the best place. So they're certainly going to have less market. And I think whatever brands are the top brands on Amazon right now are probably ones you want to get behind for that sort of thing. They'll show a big spike in sales. So that might be an interesting way to play. But I mean, on the whole, it's just guessing. You're just guessing against the conventional wisdom, basically. The other day, you mentioned that you would rethink UNG. Oh, and I can get around to it, right? That's JC. It's not Bernie. COVID recession, hurricane season is coming. Do you think UNG will play at least? And again, you gotta think about it, research it, look at it, and decide what the best play is going to be. I'm certainly not adverse to having some stock positions, but you know, it's, you got to be sure that you know what you're doing as far as that goes, especially with things like natural gas. You know, you don't want to overextend yourself. It can move very, very badly against you. I know you're talking about UNG, which is the ETF and isn't so bad to play. It's also very cheap right now, if I remember correctly. UNG. Let's see. Yeah, look, $10. But you know, we just saw USO collapse. So be careful. You know, JC, you bring up a bunch of things, and you say, and as you see, there's a lot of moving parts. The hurricane season is coming, but it's a recession. That doesn't help. And so we have a play. We have some longs in UNG. We think it's going to go okay, but I gotta just decide whether I'm going to pull the plug or not. That's going to have to inspire me, is having to do the review on the portfolio and have to figure it out. Do you think we'll get an infrastructure spending plan? What COs are, what companies are attractive in if this should happen? Well, Caterpillar's usually benefits from infrastructure spending. Then there'd be like the usual suspects like Cleveland Cliffs and Alcoa, people who supply materials. I'm not sure where you think there's going to be this infrastructure project, though. I don't see it. Where's the money going to come from? You know, infrastructure is a joke unless it's $500 billion. $500 billion of infrastructure would be needed to get through this stuff, and I just don't see that actually happening, honestly. Oh, all right. Anywho, so I don't have anything else to say. I had no topics, I got to tell you that, and I am extremely tired, so I'm going to cut this webinar short, and I'm going to take a nap so I can be fresh into the close. That is my plan for right now. Because honestly, I just got hit so hard by being tired. It just doesn't make any sense to keep forcing myself to stay up. So if there's any other questions, please speak now if I ever hold your peace. And then I'm going to take a half-hour nap and be a much happier person. What do you guys think of that? That's my day. It's a good thing about working at home, right? It's like you naturally do stuff like that. It's always hard in my office to take a nap. I would sleep. When I had an office back in the day, I was a younger man, but I still had a chair. And if I was tired, which I was sometimes, I would just sleep in my chair. And that would be fun. And if you wake me up, as long as I have 15 minutes, I'm fine. It's just sometimes I just hit a wall and I go, oops, I better take a nap. That's all. Into that. But it doesn't take much to get me better. So hang on, let's just double check what's going on here. Nothing exciting. It's such a boring market. It's passing along, blah, 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 blah. There's nothing to buy because they, like all the value stocks, everything's been bought up. The value stocks have been bought up. The crappy stocks have been bought up. And then you can't short anything because God help you if you do. That's the problem. It's not been the best couple of weeks because we're just like, what do you got to do? It's nothing to do. You just got to sit and wait. Now, I pointed out, though, it was very important. I pointed out that the long short-term portfolio combination, one goes up, the other one goes down, one goes up, the other one goes down. But the whole time, the premium is burning away for the customers, for the sellers. And so you're selling puts and calls, the premium's decaying. So even because of our strategy, which is a butterfly strategy, more so than the LTP strategy, but that's what we've done. By parking the LTP, STP more or less in neutral, we're now playing it like the butterfly portfolio. We don't care if the positions go up or down. We're just eating away at those premiums on everything we sold. And that's what's making it effective. And because it's such a much larger portfolio, we're able to sell quite a lot of premium every single month in long short-term portfolio. Now, usually we don't do that. Usually we just try to make money and try to buy things that go up in price. But now it's very worth it for us to really sell a lot of premium and just capture that. Because if you think your market's going to be flat, you have to change strategies. And I was just talking to a guy who has a hedge fund about that too, because he has a hedge fund. And we were talking about the strategies for the funds. And I said, we were talking exactly about that. You've got to be flexible. You cannot, have a fund where you're so hamstrung that when the market changes, and that's what happens to many, many hedge funds. They have a certain investing philosophy, investing style, and we're going to do this, and we're going to do that, and we're going to do that. The more you do that, the more vulnerable you are to changing market conditioning, blowing your plan. All this option selling, whatever we do, it's very different ways to play it when the VIX is at 30 or 40 and versus when the VIX is at 20. 20 very low, 40 very high. So it's one of those two. So, you have to adapt your strategy to the time. That goes for all of your portfolios, and that's what we're going to be talking about this week when we go through our portfolios. We're going to talk about what is really worth keeping, what is worth continuing to take a risk, if anything is worth taking risk on. Here's a dividend portfolio. I think I'm going to go longer anyway. Two Harbors is a REIT. Pfizer's Pfizer. It's already up 50% though. See, it's up 50%. Do we wait till 2022 to see if it can go up another 50%? Do we cash it? You got to think about that all the time. China Telecom, very disappointing. Energy Transfer came back nicely. Altria, lagging along. I still like them. Simon Property Group, I think though they're looking good financially as far as it goes. AT&T, obviously kind of a keeper in any situation. Got Ford, nothing exciting going on there. Macy's, not exciting from the stock standpoint, but isn't it funny? It's part of the what portfolio was it? The Money Talk. No, not the Money Talk. The old Hemboka portfolio. So Macy's is it is in the Money Talk too. So Macy's was in the Hemboka portfolio and did great. And in this particular one, it didn't do great because we keep buying it. This was bought way back on 10/30. So we do keep buying it. We keep thinking it's cheap. We're going to have to definitely adjust this position if we're going to stay in at all. And Signet Jewelers, I like them, but honestly, not really performing. So why not have more cash available and more margin available to do something than keep these guys illiquid in your portfolio if they're not performing? And then Tanger Family Outlet, which I think is horrifyingly undervalued. They seem to disagree. Do we get out? Do we give up? Do we go forward? Do we sell? All stuff that needs to be answered in the next 2 days. So we have that to look forward to. And that, folks, is why I need a nap. Okay. What's a better hedge? SDS, SQQ. Wow, really? I said, anyone have another question? I'm tired, and that's what you asked me. Which is a better hedge, SDS, SQQ, or TQQ? It's not better. I like TQQ because it's the same as SQQ, except it goes the other way. So in other words, SQQ is ultra bullish. I'm sorry, ultra bearish. It's an inverse ultra bearish ETF. So in other words, the NASDAQ goes down 10%, SQQ goes up 30%. On the other hand, if the NASDAQ goes up, if the NASDAQ goes down 10%, TQQ goes down because it's a 3 times ultra long ETF. So you get a lot of movement out of that thing, but the put pricing isn't that great. It doesn't quite work out. You do okay, but it's really sort of annoying that has that. And that's unfortunately where it ends up. So TQQ, I liked it because it was higher. That was my main premise there. It's just TQQ had more room to move. And SDS is also perfectly good. Because we're using options, we could make something out of anything. Because the options allow us to increase our leverage and do whatever we want in the contract for the future. But here, TQQ, see, they're at 95. So my logic was, if we take the 100 and the 60 bear put spread, we'll do well. But the problem was the 160 bear put spread is a bit expensive. The pricing doesn't really match where you want it to be. So unfortunately, it's not the best instrument to try to do those TQQs unless you're doing it in a better brokerage situation than the one we have, where I'm showing go through TOS. Not that they're terrible or anything, just that they have rules that make it very difficult to do. It's just it's the same way the roulette table isn't, the roulette wheel isn't against you. It was just told to put a 0 and double 0. It didn't purposely land on that number. It just happens. So here's SQQ, and they got a little 50-day average here, which I think is probably calculated for this period, not part of the White House. We'll see when they can issue the next one. But either way, so this one's going to go 79, and if it goes up, if you go down 10% in the NASDAQ, this will go up 30%, but 30% of 9 isn't very exciting, is it? It's only $3. So it's only going to get to 12. Trade. SQQQ. Here's the problem. So let's say we take the September period, just for an example. So you're only going to get to 12. Your target is 12, so 90 cents. And what are you going to take otherwise? So let's say you take these 180 ones, the 7. So you can take the 7-12 spread for $1. That's fine, though. That's a good deal. You take the 7-12 spread for $1, and if the NASDAQ goes down 10%, SQQ go up 30%, and you'll be over 12. And the spread will be all in the money. You won't get paid 100% unless it stays down, of course, but it's a good start. On the other hand, though, I'm trying it anyway. It's an experiment more than anything else, because I took TQQ to see if it would perform better, and so far it hasn't. On the other hand, TQQ is at 90, and if it goes down 30%, that's going to be $30, $27, whatever it works out to. So if you take a spread that's like the 100s at 18 minus the 80s at 9, now it's $10, but you have a $20 spread. See, it's not better though. The premiums are too high. That's what the problem is. But you can be a little more ambitious, since you know you're going to go to 65. So if you sell the 65 puts, which are 565, let's say 570, and these guys, the 80 puts, are 950, 960, 970 sometimes, you might be able to get a $4 hedge that's actually $30. That sounds a little more likely, right? That's something you want to bet on. So that's why we use those, because we know we're going to have a much bigger drop, because it's the same performance concept. You're going to get the 3-to-1 leverage. So if one's much higher, 3 times 30% of the much higher number is a lot more than 30% of the much lower number. That's the best way to think about that. And that is it. Okay, I'm super duper tired. I don't think I've ever been this tired doing a webinar. I was just going and going all day, and I didn't realize I was hitting a wall. Anyway, sorry it's short, but I'm going to cut it short here, and I'm going to take a nap, and then I will be back for the close. He said famous last words. All right, guys, we'll do it again next week. I promise to be in better shape. Have a good day.